Hello and welcome. My name is Matt Henderson and I'm an investment analyst here at True Potential. Today I'm going to talk to you about the latest round of central bank announcements that we have received. Central bank competency is essential for the smooth functioning of a modern day economy, and the task isn't easy. Bank leaders have a tough job judging the right level of interest rates and when to intervene to sustain growth, maintain employment and control inflation. Last week, three of the world's major central banks, the US's Federal Reserve, the European Central Bank and the Bank of England issued their latest readings, each providing an outlook. In general terms, they're looking at the hard data, interpreting how the economy has performed and how this might impact their future decisions. While the ECB is looking at restarting its use of quantitative easing, which is a form of unconventional monetary policy where a central bank will inject capital into the economy via the purchasing of instruments like government debt or bonds, ultimately lowering interest rates, and the Fed is looking to cut interest rates, the Bank of England sits in a more precarious position in terms of deciding what to do next. Since the last Bank of England meeting, global trade tensions, mainly between the US and China, have increased. The UK economy has also had to contemplate what a future trading relationship will look like with Europe and beyond in a post-Brexit world. Thankfully, the worries generated have not been nearly as damaging for the whole economy as forecasted by the bank. But one of the areas that has taken the warnings more seriously is business itself. This is reflected in business sentiment surveys. The lack of certainty and the low confidence is thought to be holding back investment. However, Mark Carney, the Bank of England governor, faces a hurdle that no other governor has faced before, which is Brexit. The Monetary Policy Committee, or MPC, is fully aware of the risks this poses to the UK economy, but have struggled to offer any sense of the opportunities that may arise. The MPC has always stated that interest rates could either rise or fall if we saw a no-deal Brexit, and the movement of rates would depend upon supply, demand and the exchange rate. This is code for we will wait to react whatever comes our way. The lack of visibility around the outcome of Brexit increases the difficulty of forecasting what the future of the economy will look like. This makes setting forward-looking policy challenging. There is a strong sense that unblocking the Brexit impasse will unleash pent-up investment, and this will restart the economy in a positive way. We are also hearing of new policy initiatives from politicians around spending and tax cuts, which, if are enacted, should boost growth. This offers a great opportunity for potential to be unleashed. Overall, the consensus view we are receiving from central banks is that the US-China trade dispute is having a detrimental impact on global growth, which has slowed relative to 2018. However, central banks are reminding us that they have many tools in their war chest to combat faltering growth, whether this follows a path of expectations via interest rate cuts or with the ECB reintroducing QE to its economy. The Bank of England remain in a different position to the rest of the other major central banks. The Fed and the ECB have suggested interest rates may be cut, whereas the Bank of England, for now, is on hold. Thank you all for watching.